In the dot-com era, when Bezos started Amazon, right? He had to spend a tremendous amount of money on data centers and warehouses. You had to sort of like scale up to eventually take advantage of the infrastructure that you had paid for. The faith in sort of like that dynamic has continued into the market today.
The problem is the input for every other asset class isn't opportunity cost, right? Like PE, it's like you already have big companies, you trade them hand to hand. Founder opportunity cost becomes the input.
When I went out to raise the first fund, I remember, there's gonna be this thing that happens before seed, like called pre-seed. I just remember like LPs laughing in my face.
We were going to call this Grumpy Old Men, but I figured out this is a better segment. Our segment when we have Kent Goldman from Upside Partners is like hilarious because he is Upside Partners. What we're really doing is Grinds My Gears from Peter Griffin and Family Guy. This is an episode of Grinds My Gears, and over time we can have our grumpy friends call in and tell us what really grinds their gears.
I mean, I basically grew up in Quahog, so like that's a fit.
It's great. Grinds My Gears. I never know how this stuff's going to come out. Kent is been a friend for what feels like 20 years. It's probably close to that. Who are you and what do you do?
I have a pre-seed and seed fund called Upside Partnership. We've been around since 2014. Before that, I was a partner, I think the second West Coast partner at First Round Capital.
Have you been doing Upside since 2014?
Yeah.
That's wild.
One of these days it'll hit. But I think, and one of the funny things is like when I went out to raise the first fund, I remember, there's going to be this thing that happens before seed, like called pre-seed. I just remember like LPs laughing in my face.
Is this, maybe we should go through the therapy of like, why are you a grumpy old man? We know why you're old.
No.
These and outcomes are actually the first money in. I was thinking about this this morning. Like, do we have the company yet where the first money in, right? Everyone likes to say SpaceX, right? Comes at a crazy valuation. It's like Elon was $100 million into that. You know what I mean? Like,
the other thing is like when I one time, I worked with a guy he was an associate at Founders Fund when they made the SpaceX investment. He is a founder sort of that we'd backed when I was at First Round. And I remember I pulled him aside and I'm like, take me through that investment. Cause it just seems so wild. And right. Like, again, when you think about sort of like venture, at least I tend to think about sort of more capital efficient businesses. And he's like, well, Ken, he's like, that's where you're wrong. He's like, SpaceX was actually, from a venture standpoint, he's like, it actually felt pretty capital efficient from the get-go because he knew like you had to do one thing to get one rocket into orbit. And if you did, that unlocked so much government funding that sort of like the rest of the progress was basically sort of like guaranteed. And he's like, to get all that non-dilutive capital.
Which is like a great way to size the experiment too.
And I thought that was a great sort of like iconoclast way to sort of like think about things. I never would have thought about it that way. Mercor, by the way, $3.6 million seed round from General Catalyst. But at the time, and that was in 2023, is that right? But I think at the time they were basically doing, it was like a hiring business.
We can debate whether you want to back the thesis or not. But I guess my point being like, even the ones that are touted today had setups where it was like, here's a little bit of money against a thesis to run some experiments. What else grinds your gears?
In general, I think a lot of people don't understand finances. I was at this like thing with a bunch of seed managers a couple of weeks ago. Generally, I don't go to too many of those things, but I was at one and why am I'm a grumpy old man? I'm like a New Englander of Jewish descent, right? Like it's sort of like, it's like...
So we always joke that we're the grumpy old men of Silicon Valley who are like yelling at the people to get off their grass and let's do it like 1993. We're going to try to avoid that. But let's start with what does grind your gears today?
I mean, if there are two like macro things, which get me sort of like right now, I'll start with like the more recent one in history, which was, I remember when sort of like seed rounds were this unbelievable thing. And basically seed capital and the whole notion of raising a seed round only came about because you had these massive data centers which were built out. And so to start like that anyone could use like AWS, you could start a company with a credit card and an idea where, and you could build some product and test it out and see if there's interest. And if there was, then you could go on and sort of raise more material amounts of capital. If not, maybe you could exit for a couple, high single digit millions and everyone would make a little bit of money. That came about and was like a revolutionary thing because in the dot-com era, right, you had to raise 50, 60, $100 million just to build out your data center to then, you could then go build your product on top of it. And it's just sort of like So like I think about that all the time right now, given that sort of like we're in this massive sort of like data center
What's the
build out.
parallel?
Well, I mean, some of it is that I think with just seed investing now, seed rounds have gotten larger and larger. The notion of a seed round actually being sort of like an opportunity to like test an idea and take some optionality on an idea, like that's kind of gone away. When you're raising tens of
All
millions.
right, so this is important. Here we go. Grinds my gears actually relates to founders here. I obviously agree, so I'm trying to like figure out how to ask these questions nicely. Why can't you raise a $10 million seed round and have it be for testing? Like, it sounds good in theory, but what are the realities of why overcapitalizing like takes you away from the test and option mode and into fuck, I have to really do this?
I mean, some of it is human nature.
Okay.
If you have $10 million in front of you, you're going to use it, or you're going to think, I'm going to try to hire lots of people, as opposed to sort of just, I mean, going in the struggle. Like starting a company it's an impossibly hard thing to do, right? I mean, when you actually think about like when you and I think in the Valley, right, we kind of take it for granted a bit, but like you start off with an idea and you're like, I'm gonna take an idea and I'm gonna go ask people to fund it. And then I'm gonna actually go turn it into something that millions and millions of people use. And like it's a really incredibly hard thing and difficult thing to do. And you hit a lot of like roadblocks along the way. Sometimes, like oftentimes those roadblocks actually give you more creativity or they help you solve a problem that you didn't even know you had. But when you have lots of capital, the easiest thing to do is just to spend more capital.
So I have another answer. So your answer is you're going to spend it and get talking into weird places.
Well, and well, the other thing is you also take away the optionality of like a modest positive exit.
Well, that's my big take is, and not even the exit. So I'm wrapped around this idea of our big gripe is this became an asset class, right? This was like a little boutique thing where you could throw a little bit of equity and make a lot of multiple, and the carry was great, and it wasn't an asset class. It becomes an asset class, and everyone's like, Will, stop whining about it. It's fine. It's fine. The problem is the input for every other asset class isn't opportunity cost, right? Like PE, it's like you already have big companies, you trade them hand to hand. So the thing I've been trying to figure out how to communicate is like, we can only get as big, right, as the opportunity cost of founder. Founder opportunity cost becomes the input, right? So if you want to scale, you need more founder opportunity cost. Does that make sense? You need more founders saying, fuck it, like I'll sacrifice my life to go do this. And then you do it when you're increasing your money's cheaper, but their opportunity cost stays the same amount. And so you end up in these worlds. So that's like my North Star now is like, how do you get aligned with a founder's opportunity cost? Because that's the right way to do things. And the issue is like, you take $10 million. If you find out you're wrong after $2 million, right? Like, which is like a standard slow setup or whatever. Like, hey, take $2 to $3 million, run an experiment. If you're right, we're on the track. This is great. If you're wrong, like, great, let's go figure out what else to do.
Yeah.
If you take $10 million, you're stuck with $8 million, which is like 5 more years of your life. When you really should just say like, I was wrong. I'm going to go away and think about it and come back. That's my big issue with the overcapitalization.
Yeah. Well, and I think too, like there's also behind that, right? There's a big sort of like underlying shift, which was that not that it's ever sort of like easy to raise money, but it used to be that sort of like it was like the founder need to pull to get some funding so someone could leave a job and try something out and experiment. That was the pull to get dollars, and people used to get from the old doctor, dentist, lawyers and stuff, and then the angel rounds and then seed professionalized. But it was a pulling mechanism. But what's happened now, like I think sort of like writ large, when you look at sort of like why is there a $10-20 million seed round happening? There's no reason to sort of begrudge founders for doing that, because if someone's going to offer you more safety and security, it's understandable why someone would take it. But it's because as funds have gotten bigger and bigger, I think venture funds are trying to solve for their needs, in and
100%.
around sort of like check sizes and deployment, as opposed to actually solving for the needs of, the founders or company building.
Well, yeah, they're solving for asset management, which is like, I know only 3 companies are going to matter. Right. And so I just like want to manage as much money and hope I get one. And
Yeah.
like those 2 things come at the expense of founders.
And I'm going to deploy a bunch of money, and it's FOMO.
Before they became asset managers, why do you think the benchmarks of the world let Josh and you guys build seed? I have a theory that's like not kind to seed investors, but Why do you think everyone's, no pun intended, seeded that ground? And it's not because they were managing huge funds at the time. But
I think you could say that sort of like we solved the problem for them. Seed funds help fund more companies, which are then sort of like more established venture funds could then sort of like look at, and they'd already have seen sort of whether or not a company had sort of like proven itself a little bit. So I think sort of like we helped it sort of like expand the pool. And, if you go back in the history of seed funds early on, I mean, I think the first fund that I worked on, first time was like it was under $130 million. And we were 3 or 4 times the size of most of the other groups. And so we're still small enough where like, we didn't get in the way of anyone's ownership, so we could kind of be pushed around. So it didn't
well,
hurt anyone.
that's like the funny open secret is that I've heard, at least, right? It is they looked at it as like an irrational risk reward that they got to ride
Yeah.
for free. Now, I think they got some of the calculus wrong, that you could make more progress on $2 million than they thought, but that, like, there's somewhere in the annals of history, there's one of the founding partners of Benchmark, somewhere in the internet, talking about how, listen, Uber was like irrational till it wasn't, right? This idea that consumer companies, until consumers have customer data, like it's an art project. And he's like, great, everyone was willing to fund these art projects. And then we could find the science project from. I think they didn't appreciate how much progress you could make. You know what I mean? How far
Yeah.
you could take the experiment on a few $1 million. But
But
that was always the funny thing. Is like they were like, oh, that's an irrational trade. I'm glad somebody else is picking it up for me.
but just keep it in mind, sort of like you're staying on the Uber thread. People forget that it wasn't until after Uber's Series B round that they started doing Uber X. It was only black cars still through that. So like, they're still like, it's just sort of like, it's
So
right. And Benchmark came in at the A.
yeah,
So
but this goes into another thing I tweeted about today, which is I think TAM analysis doesn't exist. I think I said it. What did I say today? TAM analysis is theatrical, like judgment theater.
yeah, because ultimately you want to create a new market.
Well, no. So here's how I write Uber, and I use that one, which is I like spend on the problem you solve, right? So like my analysis is like, you built something, it solves a problem for people. How much money do people spend solving that problem? And then you can have other versions down the line, but like I'm going to fund you to like build a product, to run an experiment, see if you solve a problem, how much people. I think the elegant way to think about Uber was like when Gurley invested, they were solving customer acquisition and utilization for black cars, right? Like if you really got down to it, that it was probably worth 500 million bucks. You know what I mean? Like there was a 10x for him in the knowable spend pool where you're like, hey, if they're really right and they winner take all this marketplace for riders and black cars, here's why it's a $500 million company. And that's how I actually justify the analysis. And then I own a call option on them being smart and it being a bigger deal. But like,
See, that's exactly it. And like, that's kind of in some ways, right, exactly what I was talking about before. It's like these smaller rounds, like you'd test an idea and, learn something and go from there. But by the way, I just sort of say that, like the other sort of like funny story just about sort of like, that time or that era when sort of like venture funds came about or seed funds came about. When I received the job offer at first round, I remember, I was leaving, a role, some like Yahoo Corp Dev or whatever. And I reached out to a friend of mine, and like, this is when Yahoo was going through like there's like the hostile takeover from Microsoft. And it was just like not a fun place, like incredible people work there, but like overall, like not a fun place to be. And so I was like, sort of like just desperate to get out. So I got the offer from first round. I called a friend of mine who was in the venture world. And I'm like, what do you think of this? What should I do? He was like, well, Ken, he's like, if you really want to be in venture, the best way to find a job in venture is to have a job in venture. So you may as well go to this place. And then after 6 months, you can start looking around and you'll get hired at a real fund.
that was my thing with industry ventures. I'm like, this makes a ton of sense.
Yeah.
It's really intellectually awesome. It won't work, but my business school essay is going to be fucking rad. ... $9 billion of AUM and $1 billion of enterprise value later. When you're really honest with yourself, what do you think the edge of 20 years of doing this right now? As opposed to like saying it's not fair, they do big things. Like,
this is my office, right? And like it's more or less just me in here. I spend most of my day just like kind of like that, looking up at the ceiling. And I think it's like, I sometimes think it's a disadvantage because so much of what is happening, again, not from a technology standpoint, like, but from a venture industry structural standpoint, it just doesn't make sense to me. And it's sort of like, they're just sort of like different patterns that, you see over time, but like I almost feel like I've probably been around for like too many cycles at this point.
I don't know. I
I
this
it,
is
be,
this is the So the piece I've made, the thing you and I really screwed up is one, this actually makes total sense to most people, right? Like all things, everybody's smart, their incentives are just weird, which is like
yes.
everyone needs this to exist at more scale than I ever thought. My thing is there are a lot of people who don't actually care about liquid returns, both GPs and LPs, right? It's like there's a great piece to be written about how allocation theory ruined liquid returns in all asset classes because like you're just happy to have your assets parked somewhere that you're supposed to have them parked. I think you and I missed that. That said, what always baffles me is even in the last, maybe not the last 18 months, but even the last 36 months, the really important companies still start from obscure non-consensus places, right? I mean, I like that's the thing that I don't know. I wake up when I like back like this, I come back and it's like, no, like the most interesting rounds still happen, quote unquote, off platform and in places with people that, you know what I mean, will sharpen their pencil a little bit and run an experiment with someone. I think it's harder to find founders who my tagline now is like are crazy but inevitable. You know what I mean? It's harder to find those people
Yeah.
because you're overwhelmed with central casting. But I think the hopeful part is like the good returns still start. They very quickly migrate on platform, but they still start off platform.
Yeah. Well, I mean, I think they're probably right. There are probably two categories, right? There's some of like just the big movement shifts, like with OpenAI, Anthropic, you're going to see just some things are sort of like you could call it sort of like broad bets in an emerging space that everyone knows about and plows money into. That doesn't mean that, that sort of like all of the bets in that space are going to make money. I think most of them are going to lose a phenomenal amount of money. A phenomenal amount of money. I think but then there's also sort of just the idea of sort of like, well, everyone's looking here. That means people have taken their eye off the ball in so many other places. There's a lot of opportunity there. I don't know. I love like these sort of like businesses which sort of seem kind of niche, and then the next thing you know, you have like a couple 100 million of very high margin ARR.
Yeah. Well, and even in the hot stuff, I don't know the answer, but like was Scale AI's first round 10 million from 60, right? Labeling what you think of labeling businesses aside, you know what I mean? Or Mercor, like were those first rounds 10 on 60 pre? I don't think so. You know what I mean? I think they were still quirky and small.
Want me to look them up?
Data always gets in the way of Will's stories, though. I'm not a great fact guy, but I mean, I guess that like just while you're looking, that's the thing that keeps me hopeful, right? Is that like we talk about it as the illegible to legible transition. You could park a bunch of AUM in legible shit, but the returns still come from funding things that are illegible that become legible.
According to Crunchbase, CLA raised I don't know if this is really right, but 120K seed round in August of 2016, and then a year later, July of 2017, was a $4.5 million Series A, led by Excel.
Yeah, like that. There's no reason a you like if you were out there and
That's
had
a
a
seed round.
totally. I mean, I guess this is my point. Is like we're still waiting for the counterfactual where the important companies and outcomes are actually the first money in. I was thinking about this today, this morning. Like, do we have the company yet where the first money in, right? Everyone likes to say SpaceX, right? Comes at a crazy valuation. It's like Elon was $100 million into that. You know what I mean? Like,
Well, I mean, the other thing is like when I one time, I worked with a guy he was an associate at Founders Fund when they made the SpaceX investment. He is a founder, sort of that we'd backed when I was at First Round, and I remember I pulled him aside and I'm like, take me through that investment because it just seems so wild and right. Like again, when you think about sort of like venture, at least I tend to think about sort of more capital efficient businesses. And he's like, well, Ken, he's like, that's where you're wrong. He's like, SpaceX was actually from a venture standpoint, he's like, it actually felt pretty capital efficient from the get go because he knew like you had to do one thing to get one rocket into orbit. And if you did, that unlocked so much government funding that sort of like the rest of the progress was basically sort of like guaranteed. And he's like, to get all that non-dilutive capital.
which
Um,
is like a great way to size the experiment too. But
and I thought that was a great sort of like iconoclast way to sort of like think about things. I never would have thought about it that way. Mercor, by the way, $3.6 million seed round from General Catalyst. But at the time, and that was in 2023, is that right? But I think at the time they were basically doing it was like a hiring business.
We can debate whether you want to back the thesis or not, but I guess my point being like even the ones that are touted today had setups where it was like, here's a little bit of money against a thesis to run some experiments. What else grinds your gears?
In general, I think a lot of people don't understand finances. I was at this like thing with a bunch of seed managers a couple weeks ago. Generally, I don't go to too many of those things, but I was at one and people were talking about sort of like how the razor thin margins that a lot of AI companies had, razor thin gross margins. And this one guy sort of raised his hand and goes, well, how do you define gross margin?
All right. You and I obviously share this one, right?
And
But it doesn't grind my gears anymore because I actually think that's like one of my edges in the market is I care, right? So
well,
like,
but let me push back on that, right? Because for you or I in our investors do well, eventually these companies have to get liquid, and they'll either sort of go public or sort of like be acquired. Maybe they're acquired by a private company, but for simplicity's sake, let's assume they're acquired by public companies, right? Public company and public market investors understand financials. So eventually, sort of like everything has to come into line with the public. Everything comes into line with the public market. So I would prefer to have it like, I don't know which way the video is going. Like if I have my arm going in the right direction, I'd prefer to have it going like that way as opposed to going like and being at the bottom of a $3 billion preference stack.
yeah, well, so okay, but I think you and I have had different approaches to this being one of your superpowers that like you can read three sheets in a financial statement and you care, right? Your approach has been like, I'm still gonna look at software businesses. I'm just mad because like nobody else forces discipline around these things or like looks at it the right way. Mine has been like, I'm gonna find businesses that are totally logical, but you have to read financials. So my favorite one is my lumber mill, which is like,
Yeah.
oh, everyone's like, oh, cool problem, cool story. How's that venture returns? It's like, did you look at the math? The
I
math,
know.
if I'm right on the innovation, the math is like wildly equity efficient. You know what I mean? So that's the way I've taken it is there's a bunch of parts of the world that are going to be disrupted that I think everyone would agree on the plot, but you have to do financial math and understand it in order to understand why it can be venture returns.
Yeah, but so like you can have the confidence of doing that because you're a 6'8" former national water polo player. I'm a 5'10" on a good day neurotic mess. So I see that and I'm just sort of like pissed off and jealous. I'm like, and I have to hear about like everyone else's like markups on businesses that make no financial sense whatsoever. And I'm there like,
Come do
what?
lumber mills with
Like
me. It's gonna be
what,
rad.
why did I invest in the profitable thing? Like,
But like,
it's such a curse.
why do you think you can't go do lumber mills?
No, I think I can do lumber mills. I'm
Oh,
with you. I'm just sort of saying I don't have like the same self-confidence and wherewithal that you do, where like
to
invest
invest
in
in lumber
lumber mills
mills.
and be like, feel good about it. I'm like, I'd invest in a lumber mill and be like, oh shit, I should have invested in everyone's investing in brick companies. I should have invested in the brick company.
I just want to maximize my odds of being invested in things that do 500 million of EBITDA or 350 million of free cash flow. And if they trade at 8 times or 80 times, they'll win and it'll be
I
great.
mean, you and I have talked about this before, right? It all like every investment I like, maybe it's not the right route, but I always think about Charlie Munger.
I mean, listen, that word, like that's Will's happy place. I think you can do it and put enough optionality. And I think here would be my push to you as a friend. I love it. Love it. Here, wait, no, mine's not in at the office anymore. You know what Yoni got me? I need to put it in my office for calls like this. Yoni got me the Charlie Munger Squishmallow that they gave away 5 years ago. I have a Charlie Munger Squishmallow because they own Squishmallow.
That's so good.
Here would be my push. I think the issue is if you look to do it in the sectors that feel like they're supposed to be venture capital with that approach, right? That everyone else is legible to. I think you end up with things that don't have the optionality you need.
Say more.
That if you have people the founders that are attracted to software who are going to do like have big call options in them, right? I think those are legible to people with way different costs of capital than you and I have. And so one, I think they like out of the gate or very quickly in their arc, right, are like given a free credit card with a low interest rate to build their business and start doing unfundamental things, right? And on the opposite side, the people who get there quickly in the legible sectors, I think this like are kind of like everyone's like, okay, that's nice, but that's like my job at my job at Andreessen is not to like price a really good business. You know what I mean? It's to mark up something that might be incredible. And so
Yeah.
I wonder if you take the Munger approach to the legible sectors, if you just inherently end up with things that are always going to be good, but have very low call option value. I've never thought about it that way, and I'm not judging it. I mean, there's things you've done that I wish I were in that I think have option value, but I'm
Yeah.
positing that live.
Yeah. The other thing, right, which is a tricky, like, I mean, it's easy to sort of say like these bad behaviors, like, you like spend too much or you're hard, but there's also something just in terms of like how you build and price a business. In general, I think there's been this belief eventually scale solves all margin issues. I don't think that's always true. I mean, I think like if you go back in time, right? Like that we use that example we were talking about before where when a company in the dot-com era, when Bezos started Amazon, right? Yeah, he had to spend a tremendous amount of money on data centers and warehouses, but and just to be in business. And he had to lose a lot of money on the way to sort of eventually sort of like getting things, where you could have more of a profit margin. And that's not the most profitable part of their business, or the commerce part isn't the most profitable part of their business. So that might not be a great example. But like you have to sort of like scale up to eventually take advantage of the infrastructure that you had paid for, right? And then I think you go through like the network effects era, which, similar, with sort of all the social media stuff, where like you had to scale till everyone was on a platform before you could actually really start sort of like monetizing. I feel like that, like the faith in sort of like that dynamic has continued into the market today. And I don't necessarily know that I see, like, this is just one of those periods that I don't necessarily see what the network effect or scalable sort of defensible moat is.
Well, this is what I was going to say of like, why is it hard to have a more Munger than Paul Graham view when you're in legible sectors like software, et cetera? And I think one of the issues is like, you still need people willing to run a crazy ass experiment, right? So like we just follow, you're like, great. My job is to go do something, have a crazy thing that if correct, right? A novel crazy take that we can prove is correct. And if it's correct, it's wildly valuable. Having people who will do that, and then when it's right, have enough confidence in their moat that they don't need to grow at 500% year over year, right? My whole thing's like, I don't understand why every product has a finite amount of market it can eat. I don't know why we have to eat that in 3 years and not 12 unless you
Yeah.
have no durable advantage. Right. So this is like coming to me a little bit. It's like, I think some of the problem is you do things, they're not quite crazy enough. They're not quite defensible. It's a good business, but then you know what I mean? Then they're stuck in between, in betwixt. I don't know.
I just always try to think like, what is the end state defensible moat?
Well, and the problem in software is that everyone kept investing in software when that had bad answers. Because my job as a venture capitalist is to invest in software. And the answer is like, well, no, your job is to invest in like novel hypotheses that can be right or wrong. You can prove are right or wrong. And if they're right, they're like wildly valuable. That's actually the job, in my opinion. And everyone's like, no, am I stock in software companies? I'm like, I don't know if that's the job.
For me, like that is one of the fundamental things. It's just, what is the defensible moat? By the way, if the answer is like, we're going to have a bigger brand than anyone else, okay. But it's really hard to know who's a good brand builder
I mean, the
at the seed
subjective
stage.
stuff like that for me is very hard at the early stage. All right, what else we got?
Maybe I'm not grumpy enough now. I don't know.
No, this is great. Should we can it? Should we put this in the can? This was pretty good.
Sure, way back when in this conversation, I think I told you there are two things I was like grumpy about.
What's the other thing that grinds your gears?
What did I can't remember if I went back in time.
Now you're doing the old part where you can't remember.
Now I'm old. Yeah, I'm just old. I'm just old.
I think this is pretty good for a first take of grind my gears. We can run it back after we see how everyone likes it. I think we should do grind my gears every once in a while.
I'd be happy to be a
recurring
a recurring guest.
My unbranded podcast with no distribution.
I mean, I just like hanging out with you. I mean, I think the funniest thing too is it's like we could have, like, originally when I looked at my calendar today, I'm like, oh, am I supposed to go over to Will's house?
Well, I mean, that's the funniest. This is like the longest you and I have talked in a month, and we live 100 yards apart.
Yeah.
This is our scheduled way to hang out without our wives.